Welcome to the deep dive. Today, we're really digging into macro trading strategy, looking ahead as we get into the later part of 2025.
Yeah, we've gone through a bunch of analysis looking at bonds, equities,
Yeah.
and also what's happening in crypto right now, which feels like a bit of a low conviction environment.
Exactly. And what we want to do is give you a solid framework. The sources we looked at keep coming back to this core idea.
Right. It's this three-part alignment you need for successful trading. First, the trader's readiness. Are you actually ready? Second, the market environment. And only then, third, the specific trade setup.
And this is crucial. The sources hammered this home if you miss even one of those. Your profitability just tanks.
Yeah, they basically cancel each other out. It doesn't matter if you found the perfect technical setup on a chart.
Right. If the overall market's dead or if you're personally stressed or unfocused.
You're just setting yourself up for failure, or at least suboptimal results. It forces you to think more holistically.
It's not just charts and numbers, it's also about the person clicking the mouse.
Precisely. So today we'll unpack that, look at why bonds might be presenting a kind of weird opportunity, and why the stock market, even though it looks healthy on the surface, might be stalling out.
Okay, let's start with that foundation then, the human element, the trader psychology. Our sources kept saying this is number one.
Yeah. The big realization is trading is going to come all down to when the trader is ready, not when the market is. That's the key.
That really flips the script for a lot of people, I think.
It does. Because if you're not ready, if you haven't done that internal work, checked your emotions, reviewed your own risk tolerance that day,
Then what happens?
you'll mess up even the easy trades. You'll get jumpy, cut your winners way too soon, maybe let a loser run because you're hoping, not trading.
And just end up stressed out, right? Even if the initial idea was sound.
Totally. It's like having a great recipe but being a terrible cook that day.
Yeah.
The results isn't going to be good.
Makes sense. It's about execution, not just the plan.
Exactly. But, flip side, if you are ready, if you're centered, focused, prepared.
Then you become this super trader.
That's the term they used, yeah. Your risk management suddenly gets way better. You handle drawdowns without panicking. And crucially, you let your winners run longer. Why? Because you trust yourself in your process.
So the takeaway is almost focus on yourself first, market second.
In a way, yes. Get yourself ready. If you're not, the best market setup in the world won't help you capture it properly anyway.
Okay. Self-awareness first. Got it. So once the trader feels calibrated, step 2 is timing the market environment. You mentioned this 6-week cycle.
Right, the 6-week cycle. Think of it as a tactical tool for position traders.
Yeah.
It's basically the price range that gets established between each Fed meeting.
So about every month and a half, you get a new defined range to work with.
Exactly. That window becomes your playground for maybe accumulating a position, managing your risk around it, and potentially closing it out before the next Fed meeting shakes things up again.
Interesting. So the Fed meeting isn't just about the rate decision. It's about setting these boundaries for volatility.
That's a big part of its function for this strategy, yes. The idea is to look for your volatile moves, your entries, early in that 6-week period.
Okay, why early?
Because that's typically when the bigger expansions happen. The strategy favors entering in predefined zones within that cycles range, maybe around the 50% retracement level, or sometimes even the 75% level if you're fading an initial move.
And you mentioned avoiding the end of the cycle, like the last week or two before the Fed meeting.
Yeah, definitely avoid chasing new breakouts or initiating major positions then. Why? Because big sustained moves are just less likely right before a major event everyone's waiting for.
Things tend to quiet down.
Right. Volume often drops. People take profits, wait and see. Entering late often means getting stuck in choppy, directionless price action. It's usually a poor risk-reward proposition.
Okay, so this provides a systematic timing filter. You're ready personally. Then you check if you're in the right phase of this 6-week cycle.
And only then do you pull the trigger on your specific trade setup, the one with the directional plan and the clearly defined risk.
It's all about lining things up, the power of alignment, as you called it earlier.
That's it. You're stacking the probabilities in your favor. Because even if the trade takes a while to work out, if the environment is right and you're right internally, you can manage it properly.
All right, framework established. Let's apply it. How does the current market environment look, say, for September 2025? What are the health signals?
Broadly, the sources say conditions are still pretty risk-on. That's generally good for stocks and other risk assets.
What tells us that?
A few things. Credit spreads are really low, like historically low.
Okay, remind us credit spreads.
It's the extra interest companies have to pay on their debt compared to super safe government bonds. When that spread is narrow, it means the market isn't worried much about companies defaulting. It's a sign of low economic stress, sort of a nobody's worried indicator.
Gotcha. What else?
Well, the VIX, the volatility index, is pretty tame, comfortably under 20, and market breadth looks healthy too.
Meaning enough individual stocks are participating in the up moves, not just a few mega caps.
Exactly. A good chunk of stocks are above their 50-day moving averages. So, yeah, the foundation looks pretty solid.
But you mentioned a puzzle, something stalling despite the healthy signs.
Yes, this is where it gets really interesting. The yield puzzle.
Okay, lay it out for us. What's the puzzle?
Well, you've got the Federal Reserve, right? They've been cutting rates. They're actually projecting that rates will be down near, say, 3%, maybe 3.2% by the end of 2026.
Okay, so they're guiding rates lower.
Definitely. But the market,
Mm.
it's like it's not fully buying it. Specifically, look at real yields that's yields adjusted for inflation. They're around 1.73% right now. And the U.S. two-year Treasury yield, which is usually super sensitive to Fed expectations, is sitting at 3.5%.
And the puzzle is?
Neither of those yields has broken below the lows they hit way back last September, even though the Fed's been actively cutting since then. It's bizarre. They should arguably be lower if the market fully believed the Fed's path.
Wait, so the Fed is basically shouting rates are going lower, but the two-year bond market is kind of shrugging. Why would it do that? Is there some hidden risk priced in?
That's the million-dollar question. The sources we looked at lean towards it being less about some big hidden risk and more like market inertia, maybe some mispricing, because inflation expectations seem pretty stable.
How stable?
The 10-year break-even rate, that's what the bond market implies inflation will average over the next decade, is around 2.3%.
Okay, so a touch above the Fed's 2% target, but not exactly alarming inflation fears driving yields up?
Right, it's not screaming inflation panic, which leads the sources to think this disconnect, this stalling in yields despite Fed guidance, is actually an opportunity.
Ah, okay. This leads us to the so-called free money trade.
Well, free money is always a dangerous term in markets, but yet that's the idea. If you take the Fed at their word, if you believe they'll follow through on those rate cuts.
Then that current 3.5% yield on the two-year bond looks too high.
Exactly. It seems mispriced relative to the Fed's own projections. So the trade is simply to go long two-year bonds, betting that yields will eventually fall to align with where the Fed says rates are heading.
So you're basically betting against the market's current skepticism, using the Fed's guidance as your thesis.
Pretty much. It's an interesting setup based on that specific disconnect.
Okay, super clear on bonds and the broader picture. Let's pivot now. Crypto. Digital assets. We know overall liquidity is okay, right? You mentioned the financial condition index.
Yeah, the inverted financial condition index, bit technical, but basically when it's looking healthy, like it is now, it means money is flowing relatively freely through the financial system. That's generally a tailwind for risk assets, including Bitcoin. Think of it as the macro plumbing being clear.
So the global money flow backdrop is supportive. Okay, but is there a crypto-specific warning light flashing?
There is, and it's stablecoin dominance. The sources flag this pretty strongly.
Okay, what's the issue there?
It's sitting at what they call dangerously low levels, around 6.4%.
Why is low stablecoin dominance dangerous? Isn't that money in the market?
It is, but stablecoins represent capital sitting on the sidelines, ready to buy dips or rotate. When the percentage of total crypto market cap held in stables gets this low, it historically suggests that maybe too much capital has already flooded into the riskier parts of the market, like altcoins.
Ah, so it's like the pool of reserve buying power is getting shallow.
Kind of. And what often happens next, historically, is a sharp rotation out of those altcoins and back into stablecoins for safety, causing dominance to spike back up, at least temporarily. It's a sign of potential froth or exhaustion.
Okay, so macro is green, but crypto internals are flashing a yellow, maybe even orange light, which leads to the strategy.
A low conviction zone strategy, that's the term used. Basically, the market doesn't seem to have strong, immediate reasons to surge higher right now. No major catalyst everyone's jumping on.
So play defense.
Pretty much. The recommendation is to reduce exposure. Keep crypto allocation lower than usual. The sources mentioned maybe less than 10% of a portfolio, possibly even closer to 5%. And definitely use lower leverage, or none at all, on any new positions.
Right. Keep your powder dry, risk limited. If we're playing cautious, what specific levels are traders watching? Where are the potential lines in the sand?
Yeah, it becomes about structure. For Bitcoin, one source noted a current long position entered around $112,000. They're looking to potentially add more if it gets above $116,000. But the key is the risk management stop loss defined at $107,000. These are the kinds of zones being watched.
So defined entry, add-on, and importantly, exit points.
Exactly. For something like Solana, SOL, which had that huge run-up in dominance earlier, the strategy is more patient waiting for a pullback, maybe into the $160 to $180 range, especially if its dominance continues to drift lower from its peak.
And Ethereum.
ETH, yeah. The $3,800 level was mentioned as potentially interesting again, but the overall theme is the same. Identify key structural levels, define your risk tightly, and don't just chase momentum in this environment.
Okay, let's tie this back to execution and risk management, bringing that alignment framework in again. You mentioned the NASDAQ Q breakout as an example.
Right, so the NASDAQ Q index itself clearly broke out of its 6-week cycle range. Looks bullish, right?
On the surface, yes.
But then you look under the hood. A huge component like Microsoft, MSFT, it's trading around, say, $509. But it hasn't really kept pace with the index's breakout move. Just to match the NASDAQ Q's relative strength, MSFT might need to be up around $560 or higher. There's a divergence.
So the index is moving, but a key leader isn't confirming with the same strength.
Exactly, and that creates the risk scenario. What if MSFT doesn't catch up? What if instead it breaks below the low of its own recent 6-week range, maybe around $493?
That would be a big warning sign for the whole NASDAQ Q move, wouldn't it? A leading component faltering.
Absolutely.
Yeah.
It could signal the whole index is about to roll over. You have to watch that internal alignment, not just the headline index level.
That makes sense. Okay, finally, let's touch on something you mentioned earlier, the different ways people think about stop losses. This was fascinating.
Yeah, the sources highlighted a difference between how, say, a typical position trader uses stops versus maybe a more traditional macro hedge fund.
Right. For me as a systematic trader, the stop loss is, well, it's the line in the sand. If price hint it, my trade idea is invalidated and I'm out to protect capital. Full stop.
And that's the standard, sensible approach for most traders. But the sources noted something interesting. Many successful position traders, while having that ultimate stop loss, might actually reduce their position size before it gets hit.
How does that work?
It happens in what they call the decision zone, usually early in the trade, maybe within the first 0% to 25% of the cycle range moving against them. If the trade starts going sideways or slightly negative quickly, they might cut the size down, reassess if the market is really confirming their idea, all while their risk is still very small relative to the full stop loss. It's active management before the point of invalidation.
Okay, sort of diluting into weakness early to minimize potential loss if it keeps going.
Kind of, yeah. Or just reducing risk while they wait for more confirmation. Now contrast that with the big macro funds.
The ones who say, stop surfer buses.
Yeah, that's the old joke. They often don't use hard price level stop losses in the same way at all.
Wait, really? How do they manage risk then? Just hope. That sounds terrifying if you're focused on capital preservation.
It's not hope. It's a totally different approach. Their risk management is built around the entire portfolio, not just one trade. They use complex hedging strategies. They look at correlations between assets. They might short one thing to hedge a long position in another.
So it's portfolio construction and constant adjustment rather than a single kill switch on a trade.
Exactly. They have huge teams analyzing these relationships constantly. It's a different beast entirely. But for most individual traders, that 6-week cycle framework gives a systematic way to define your risk zone, set that backstop, but also think about managing the position within that initial decision zone.
Okay, that clarifies the different philosophies. So bringing it all together for the listener right now, heading into Q4 2025, what's the main message?
Patience. Really, it's patience. That alignment we talked about, the ready trader, the right market environment via the cycle, the clear setup, you have to wait for all three, even if it feels like you're missing out sometimes.
Yeah, the quote from the sources really nailed it. We are currently not in easy mode. We are currently in let us see who blinks first mode.
And that sums it up perfectly. Which leads us to maybe the final provocative thought for you, the listener, to chew on.
Okay, let's hear it.
We stress this systematic patience, right? Waiting for the perfect alignment, the optimal zone in the cycle.
Right.
But one source brought up the example of gold back in late 2024, November, December time.
What happened with gold?
Well, according to the strict systematic rules they were following, the right environment wasn't quite there yet. So the disciplined trader waited, passed on the trade. And in hindsight, that was the moment. The perfect entry, right before a massive explosive move higher in gold. Waiting for perfect confirmation meant missing the entire move.
Ouch. So the question becomes,
How do you balance that? How do you reconcile disciplined, systematic patience, which is crucial most of the time, with the ability to recognize and act quickly when a truly rare, explosive opportunity presents itself, maybe before all the signals turn perfectly green?
Yeah, that's the tension, isn't it? Sticking to your rules versus knowing when the rules might be too slow for a specific fast-moving situation.
It's a tough one. There's no easy answer.
Definitely something to think about. A great place to leave it for this deep dive. We'll let you ponder that, and we'll catch you on the next one.